Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, your host today, Thursday, April 29th. After a somewhat volatile quarter with some setbacks in parts of the equity market, and more notably a significant rise in long-term interest rates, the second quarter and the thawing of winter brought calm across markets, with volatility dropping, stonks rising, and the sell-off in the Treasury market losing momentum. With the stabilization of interest rates in April, some parts of the equity market that lagged on a relative basis, like growth and tech, regained momentum, with the Russell 1000 growth up 7% versus the Russell 1000 value up only 4.2%. The NASDAQ is up almost 6% on the month, rejoining the land of gains. With over 40% of the U.S. population having received at least one dose of a vaccine, consumer confidence is on the rise, and the pent-up demand the market expected is starting to come to fruition. Retail sales continue to come in extremely strong, and earlier this week, the Wall Street Journal noted that mall foot traffic was up 86% from March of last year. The CDC even announced that fully vaccinated Americans can be unmasked when exercising, dining, and socializing outdoors in small groups. Woohoo! Unfortunately, the same can't be said for other parts of the globe that haven't been as fortunate as the U.S. with the success of vaccination. This uncertainty at times seems to loom over the markets. However, the easy money Fed and seemingly endless fiscal stimulus plans out of Washington continue to encourage investors to brush aside these risks and continue to chase risk assets despite lofty valuations in certain parts of the market. Just yesterday, the Fed repeated that they would not change the pace of bond buying until substantial further progress is made on their employment and inflation goals. The money printer keeps burring for another day. How much did all this stimulus boost the economy? Will the strength of the consumer persist? Will this pent-up demand and stimulus create inflation? And will that inflation be sustainable? I'm excited to have a special guest today to help us answer these questions and more. Please join me in welcoming Michelle Meyer, Managing Director and Head of U.S. Economics at Bank of America Global Research. Well, welcome to the show, Michelle. Thanks for taking time. We really appreciate you coming on. I know our viewers and listeners are going to enjoy hearing about what your thoughts are on the market, especially very timely. We had the Fed yesterday. We had some GDP numbers out. So what's your kind of take on the economy these days?
So we're quite bullish on the economy. We think that we are seeing the beginning of pretty exceptional growth for the U.S. economy. And I think the data, as you mentioned, Ken, this morning, GDP growing in excess of 6%. And when you dig into the details, what you find is even stronger domestic demand, double-digit growth in consumer spending, in business investment on capital and on intellectual property, double-digit investment in residential spending as well, some weakness in commercial real estate, which is to be expected. So once you take out the inventory drawdown, which was a drag, once you take out the widening in the trade deficit, domestic demand was more than 10% up in Q1 on an annualized basis. So it is really impressive what we've already started to see in the economy. And I suspect there's much more to come as we get to the point where we're fully reopened and have reversed those pains from the COVID pandemic.
And I've seen some estimates from different economists thinking that we're going to peak this quarter and perhaps trail off. Are you more bullish than that?
So I think we're going to peak in Q2. So I think we'll get to about 10% growth in the second quarter. And then we'll start to trail off probably to kind of mid-single digit growth rate. But when we say trail off, even if we're, kind of leveling off in the second half of the year, somewhere around 5%, which is our forecast, remember what the economy was prior to COVID, right? We were growing at a 2% pace, if that. And so at 5% growth, yes, it's softer than maybe a 10% growth rate, which we think we'll see in the second quarter. But clearly, it's still a very impressive piece of economic performance. And I think what the other really important point to make here is that when you look at a level of GDP versus where we were pre-COVID, we think we're basically already at the pre-COVID level of GDP, and that will be confirmed once we get the Q2 data. And by the end of the year, we'll be at the level of GDP that we would have been if COVID never happened and the economy simply grew at trend. So what we'll end up seeing when this is all said and done, we think when the economic authorities come out and kind of review this business cycle, it will likely end up being one of the steepest declines, one of the shortest recessions, and probably one of the fastest recoveries.
So I guess the bears out there, I've seen some projections of dropping back down towards the end of 2023 to sub 2% real GDP again. Are you in that camp as well, or it seems like you're way more positive than that?
Yeah, more positive than that. I think to fall back to sub 2% growth would mean that all of the stimulus that's been pumped into the economy and more to come ends up being highly fleeting, and I don't believe that's the case, for no other reason other than the fact that the stimulus, the dollar amount, is just so large that you don't get the typical cliff-like environment where you get a burst of stimulus and then the economy has to, get to some understanding post-stimulus, right? Because you no longer have that incremental growth. In this environment, the stimulus is so considerable that there's a lot of cash sloshing around that has not been used, partly related to the stimulus and partly related to that initial COVID shock where people couldn't spend as they normally would. So there's a lot of excess savings on the household balance sheet, we think in the order of $2 trillion. There's excess liquidity on bank balance sheets, and there's excess capital on corporate balance sheets as well. And all of that should be deployed given the momentum that's building in the economy.
Yeah, I mean, one of the more interesting things we saw during this short-lived recession was the resilience of the consumer, very different from the global financial crisis, over-levered consumer going into the burst of the housing bubble. The savings rate was already elevated as we entered the pandemic. And then you saw a lot of the stimulus checks and the transfer payments being saved. And so delinquencies on consumer credit went down, which was very bizarre. And it seems like the resilience of the consumer is essential, of course, for the U.S. economy being such a large part of the economy. Do you think that the consumer is going to get addicted to the stimulus? Do you think, do you think we're going to continue? I guess a lot of it's political, but just kind of interested in your views on that. How much more can we keep pumping into the system?
Yeah, look, I think without a doubt, the household sector is in a very different place than they were after the great financial crisis, right? The household sector heading into this recession had very low debt levels, very high net worth on aggregate, right? There's lots of differences by, demographic group, et cetera, but on aggregate, historically low financial obligations ratios and high net worth. And on top of that, they had a savings buffer. So when the COVID pandemic hit, there was already some buffer there. And then all of the stimulus pumped in, which just generated an even bigger buffer. So the savings rate right now, as of the Q1 data, is 21%. 21%. Before the great financial crisis, the savings rate was anywhere between 0 and 2%.
Yeah, it's crazy.
So it's an entirely different landscape for the consumer. And I think that's extremely important to keep in mind when you're thinking about the ability of the consumer to continue to spend. Are they addicted to stimulus? Well, yeah, they've enjoyed stimulus, of course, in the last several months. But looking ahead, we don't necessarily need to see further transfer payments to the household sector or to the consumer for them to continue to spend, because there's already a lot that's in there in savings. And very importantly, we think that there's a positive feedback loop happening in the economy. The labor market is adding jobs, wage growth is holding in and maybe will accelerate. And that should then fuel future kind of more steady spending. And that in the end is the intention of stimulus, right? Government spending is not here to be the only engine of economic growth. It's there to jolt the economy when the economy needs it, and then to allow the economy kind of take off on its own.
Yeah, one of the big questions out there that many investors are talking about is, of course, inflation, something that it seemed like 6 months ago even wasn't really too hot of a topic. It's one of my things at the end of last year I was telling investors, just watch out, the inflation is going to come, at least people are going to start worrying about it. We haven't really seen much yet, but that's the concern. That's why interest rates on the long end have been going up. And people ponder is, because of all the QE, because of the fiscal spending and stimulus, it will create inflation some argue it's going to be short term, others argue it's going to be long term. And those in the short term camp are clearly bullish on long term interest rates, saying that they'll probably fall in the long run as we go back to a world of secular stagnation. What's your view on this inflation concern, and if it's a transitory or if it's more of a long-term phenomenon here to stay?
So I like the way that you phrase the question, which is giving these time horizons, because I think that's very important. A lot of times people just talk about inflation is it here or is it not here? And you actually really need to think about, are you talking about the next few months, or are you talking about the medium or longer term trajectory for inflation? So let me first address the short term. In the short term, the next few months, we will see higher inflation, certainly on a year-over-year basis because of base effects, but even month to month because we have what Fed Chair Powell, I think, very eloquently described, these bottlenecks, right? We have a mismatch, in a sense, between demand and supply, where, go back to economics 101, demand is increasing very quickly because of all the stimulus and reopening, and it's just hard for supply to catch up fast enough. And in the interim, that creates these inflationary pressures. And you see it in certain categories more than others. Think about where there's been supply chain issues, parts of manufacturing, semiconductor, for example. And you even see in the labor market, right, in terms of supply of labor taking some time. So the next few months will have inflationary pressure. We will see it in the data. But I do think a lot of that pressure, if it's because of this kind of friction between demand and supply temporarily, it will be temporary, right? The inflation burst won't continue at that rate. And I think what will ultimately drive the medium term to get an inflation move is when you get that proper overheating in the economy, you get the labor market back at full employment or well through full employment. And that I do think is in the cards, but that takes longer to play out. So when you think about the trajectory, you get this kind of big hump in the next few months, inflation settles back down, and then you get a much more steady but meaningful acceleration in inflation over the next few years as the tightness in the labor market manifests itself in higher wage pressure and higher underlying inflation. And by the way, the Fed is extremely determined to accomplish that, which is another important point, that monetary policy has changed, right? It's not the monetary policy that we had in the last cycle. It's a monetary policy reaction function, which is designed to get above target inflation. And I think that they are committed to achieving that.
Yeah, I mean, it's with Bernanke and Yellen, it was about, 1 to 2% is kind of what we want. And now we want more than 2%, right? And we'll stick to it. I guess on that front, do you think that a lot of people are saying, well, the Fed's going to have to raise rates more aggressively than they're projecting? Are you in that camp? It seems that you're not. It seems that you think that the Fed's going to be on hold further out in time.
So I think that I think liftoff will be delayed because they want to generate higher inflation. And there's many in the marketplace that are trying to kind of push the Fed and suggest, look, they're going to have to hike, and they're going to have to hike earlier because of these inflationary pressures. And my view is, when they see the inflationary pressures, they're going to pat themselves on the back and say, we did it, right? We're breaking out of this low inflation regime. Our policy is working. Let's let it go. But there is a limit. And once they feel like there's a strong enough, argument that inflation will continue to run above target, and they're convinced of the persistence in inflation, they will start hiking. And I think the way that Fed Chair Clarida has described it is very, very good, which is this idea that it's a delayed liftoff, similar to if you were in a price level target world. And then you follow what would be considered kind of an inertial tailor roll, which means you go a little bit slower than normal in the beginning because you want to make sure that inflation continues and you don't hike too fast that you derail the recovery. But then you normalize rates, and then you actually get into a real tightening cycle. So I think, to me, when I consider what the market is pricing in, I would say it's probably a later start, perhaps, than what some folks are assuming. But ultimately, the hiking cycle gets going, and the terminal rate of the cycle is probably higher than what I think the consensus would assume at the moment.
Sure. Sticking on, going back to the consumer, and they've got a lot of dry powder. They're spending a lot on many different things. Do you think that's short term? Do you think that there's a lot of near-term spending on certain types of goods? People went out and bought a new car. People went out and bought a new dishwasher. But does that spending kind of trail off? I mean, there's only so many goods that you can buy out there. I guess maybe services picks up the slack, which has been where we've been dragging here with the lockdowns.
Well, I think that's exactly right. I think where there's pent up demand, it's very clearly in services where people have been either unable or unwilling to engage in certain activities because of restrictions or health concerns or both. So when you think about goods, yes, goods spending has been extraordinary. We saw that in the Q1 GDP report today. And a lot of the good spending was driven by the fact that people reallocate their budgets, unable to do, leisure activities, but also stimulus. Whenever, 3 rounds of stimulus payments, they went into goods, particularly durable goods like furniture or home improvement, et cetera. So I think, as we look ahead, to me, the movement on consumer spending, the gains in consumer spending will be more a function of people re-engaging in the economy, probably more driven by the higher income household that has been kind of unintentionally saving. But I very much believe that there's plenty of room to go in terms of spending because of the amount of dry powder that's out there. 21% savings rate in Q1. Even if we get down to 10%, you're still talking about a lot of money that needs to flow into the economy to be spent.
Yeah, and one of the places it's been flowing from the consumer is into housing. And I know one of your specialties, starting off in covering the housing market, remember having some meetings after the global financial crisis when there was more uncertainty about the direction. And you were right, home prices went up and they keep going up. And but they, is this pace sustainable? Seems that now we're up in double-digit annualized growth rates. What's your view on the housing market, given it's gone up so much recently?
So to me, the housing market boils down to the same thing I was talking about before with demand and supply. Just again, going back to like the basic fundamentals for economics, is that there was a very, very strong increase in demand for housing when COVID hit. And it makes sense. Mortgage rates fell to historically low levels. There were pandemic related relocations. And there was an allocation of cash. If you weren't saving to travel, maybe you had more money to spend towards your down payment. So it made a lot of sense that, housing would do well. It did even better than anticipated, but, the demand story I think is quite reasonable. And supply was just couldn't accommodate that. So we got down to levels at the end of last year and early into this year of unbelievably low inventory levels. And that has created significant upward pressure on home prices. We're seeing somewhere in the order of 11 to 12% year-over-year home prices nationally, back to 2006 type levels for home price appreciation. And I think what we'll see going forward is a leveling off in demand for existing properties. So existing home sales are already starting to move sideways, and I think that continues. But new construction should continue to do well. So there's going to be more building, more churn in the new construction market, given that there's opportunities to add inventory to the housing market, and that will be very welcome because the level of home price appreciation is too high. It's in excess of where we should be. Very different than the financial crisis. In the financial crisis period, home price appreciation was more a function of excess leverage, low down payments. Very, very different. Today, that's not the case. Credit standards are very tight. Down payments are high. It's simply a function of supply and demand. And as such, once again, it should prove to be temporary, and home price appreciation should start to moderate.
Yeah. We invest a lot in mortgage credit, and we were talking about low inventories 4 or 5 years ago when it was around 1.5 million, and now you're sub 1 million. But it's good news that they're starting to build homes. I like to say, we need homes for the new families that want to get out there and buy a house, and we need that for America. So, what do you think could slow the market down? Rising rates? Seems like that's the potential catalyst to kind of just slow things down. Would be higher rates, make higher payments, and people aren't not as much frenzy towards the market.
Yeah, I think, higher. I mean, that seems to be one of the key stories, right? And that's why there's a lot of concern over a possible tantrum in the market. And that's why I think the Fed is being very sensitive as well in how they communicate. Because, whatever asset class you're talking about, the stock market, the housing market, all of it is in a sense somewhat, supported and boosted by these extraordinarily low levels of interest rates, low cost of capital. And if that adjusts rapidly, faster than the fundamentals would suggest, that could be disruptive to markets. If you look back at the move in rates in February, I think all else equal, the economy and markets handled it just fine. And I think it suggests that the increased interest rates was justified by fundamentals. It was kind of a so-called healthy rise. So it's not just, our rates rising, the speed of them, but the reason behind interest rates rising. And the next wave, the next move in interest rates, which I do think will come, I think rates will set higher again. I think it will be similar to February, where it will be based off of people kind of resetting their expectations higher for the economy. You asked Ken in the beginning of this conversation, there's plenty of bears out there that are saying, look, it's temporary rise in growth. We're going to get back to 2% or sub 2% growth. I think once it becomes apparent that that's not happening, interest rates can reset higher again.
And where do you think that ultimately ends up shaking out to, as far as, not to put you on the spot, but the 10-year Treasury, what kind of range do you think we head back up to?
So I'll put my colleagues, the rate strategists at Bank of America on the spot and give you their forecasts. Yeah. So by the end of the year, they're looking for 2.15% for the 10-year, which seems quite reasonable to me, given what we're assuming for the overall economy. So, when you think about the path forward, it's unlikely to be linear or smooth. You will likely have these kind of resets that happen in the market as people assess the outlook and the fundamentals in the economy.
Yeah, I think we agree with your rate strategists on that we're heading higher, and we're going back to kind of where we were over the last decade. And some could argue, with where GDP and inflation are, maybe we should be even on the higher end of that 2%. So I guess only time will tell. What do you think are the risks out there that people aren't thinking about? There's a lot of rosiness, there's limited, seems like there's limited walls of worry to climb outside of maybe not as successful vaccine rollouts in other parts of the globe. And but what are the risks that you see out there?
So, clearly the virus is still front and center, and I think that has to be kept in the back of our minds. We're not out of the woods yet. Things are feeling a lot more normal as more and more population gets vaccinated, but there's concerns of mutations of what's happening internationally. There's still can create some supply chain issues, some challenges on the back of the virus. So that, Ken, as you noted, is still number one. The other thing that leaves me a little bit uncomfortable when thinking about the trajectory going forward is, because growth is so strong now, and I think will continue to be strong for the next several quarters into next year, well above the potential of the economy. Are we in a sense, pulling forward growth from the future, right? Are we kind of shortening the cycle, and we'll be in later stage cycle behavior than maybe anticipated, and the next recession can come sooner, and maybe the next recession will actually be a lot more persistent, because there will actually be excesses to cut. So that is something that leaves me a little bit uncomfortable about some of the consequences of this type of growth. But it's not a problem for today. It's probably not a problem for next year. It's kind of into the future. You have to think about what all of this means in the end for the next stage for the economy. I would say the one kind of caveat to that, in the way that it's not problematic, right, is if the policies that we're seeing discussed now around infrastructure, physical and human capital infrastructure, if the technological advancements that have come out of COVID, if the more virtual workforce, all of this leads to higher potential growth in the economy. If we can actually change the structure of the capacity of the economy in a positive way on the back of all of this, then I think the cycle can go on longer and we avoid getting to that late stage early. But all else equal, we were lucky to get 2% growth in the last cycle. We're now talking about 5-7% growth. So it leaves me a bit concerned about what the consequences in the end will be from all of this.
Sure. And one last economic or business related question, and I'll have a couple more fun personal questions, but taxes seem like they're going higher. Do you think that's going to create any headwinds for the economy with taxes on the rise?
Yeah, I think we need to consider the effects of that. Now, when you think about tax hikes, it's not tax hikes that are kind of independent, right? The tax hikes are the pay-fors for these initiatives around infrastructure, et cetera. So there's offsets, right? The tax increases will come in order to have the types of spending that are desired. And we all know what, the benefits you get out of infrastructure investment. If you listen to President Biden, his address last night, I mean, clearly the focus is to create jobs, good paying jobs, middle-class jobs, and get people back to work in the goal of supporting these types of infrastructure investments, right? So I think we have to see how it all shakes out in the end, between what kind of tax changes we see and what's the purpose of that revenue, right? How is it going to be spent, and what are the economic consequences, the positives that come out of spending that? And then also you have to remember there's the corporate tax changes and the personal tax changes. And in a sense, they're in two different bills, right? The corporate side is designed to offset the American Jobs Act, the physical infrastructure. And then the personal tax increases, the tax increases on the wealthier part of the population is for the more human capital investment type policies. Yeah. So it's not just one big tax bill that's all being looped in together. It's quite nuanced. So I think we have to consider all of that when we're doing the analysis.
Yeah, I had a webcast yesterday and I had a question about how it would affect the different assets we own. And I said, you have to remember, even the income tax hike, it's not hitting most Americans. And so, the average American isn't going to hit that much, and they're going to be benefiting from some of the things coming through the stimulus. So at least the average American consumer is still in a good spot. Maybe it hurts some capital investment as people decide not to invest as much. But I guess we'll have to wait and see. So we've been over a year working from home, at least here at DoubleLine. I come in once a month to shoot this and pick up some stuff for my desk. Seems like people are starting to go back. You've been working from home as well. We talked about before we started filming. What's your favorite part of working from home?
The flexibility. There's been pre-COVID, we always talked about finding work-life balance or work-life integration, but this is work-life integration at its fullest. We kind of work and life collided into one. And then first it was really hard. I'm sure I felt it, I'm sure a lot of people felt it, is just to try to figure out how to do both, right, together in an efficient, effective way. But I feel like I found some sort of integration where I could, speak to clients across the country or across the world seamlessly, virtually, and then walk away from my computer and my camera and go downstairs and, have lunch with my kids. And I would never have been able to do that before. So, is this the optimal scenario? No, I think in the end, going back to the office, at least part of the time, I think is really valuable, and we miss the collaboration, the energy. There's a lot that you get out of being physically in the same place as your colleagues. But I think that in the end, there was a lot of benefits also from being at home, and we'll see what the future holds in that regard.
And what do you miss most about the office? Is it just the camaraderie, or sometimes I hated my commute, but in a way, sometimes I miss it. It was like the one moment I could just kind of not do anything, just be driving, listen to the radio, and you get some downtime. So what about you?
I miss the buzz, the energy, particularly being on the trading floor. The day went by in a moment. It was fun. Everybody was engaged. There was just so much movement and action, and I just found it fascinating and really enjoyable to be able to be part of that. And I think it was also really rewarding, especially for me being an economist, as I saw the data, as I would see the data come through, the high frequency data, or even the macro story change. I could observe what that was doing to the markets in real time. I can, shout over to a trader and say, what does this mean? Or talk to a salesperson or a client, and you get real commentary very fast. And it's kind of instant gratification in a sense, as you see forecasts come through one way or the other in the economy. And that's a little bit harder now. So when I, try to quote unquote cover the data for the trading floor, I'm just, typing into a chat, and it's not quite the same level of interaction.
Yeah, we use Microsoft Teams, and we've got we don't go on video that often. We've got these pictures we took, years ago. They're like our avatars, and we've been staring at that for the last year. And my team, we've started just going on video so we can see each other's faces, because that's the one problem with the chat rooms is you start feeling so isolated from everyone. So some combination of work from home and going back to the office seems like where most companies will shake out and what most people want. So I guess only time will tell. Well, thank you so much. It's been a pleasure. I really appreciate you coming on. Seems like you're on the more positive end. So, we like being positive sometimes. Bond guys and bond investors, we're often the bears out there. So it's always good to get a different perspective. So thank you, and have a wonderful weekend. And we look forward to talking to you again soon.